Hi guys, I trust you are all well. I'm just trying to switch on my video here. There you go. I hope you're all doing well, and it's so good to have everyone back this week. Now, got a few things to do this week. If someone asked last week if we could have a look at pound, GBP, USD, that's the sterling. So what I thought we'd do, and this is what I do at the beginning of every month. So I've already done it because the month has started, but I think it will be useful for all of us just to kind of work through it. Whatever currency pairs you are trading, at the beginning of every month, I recommend you just go back and have a view as to what's happening, what has happened in the past month, and what do you think is likely to happen from a price action perspective as the month unfolds and as future months unfold. Gives you a nice bad view of the markets that you are trading, and I think it's important. Now, we look at euro, dollar, and gold. Those are the currency pairs that we're trading, but it's because it's the beginning of the month and because there's been a request to look at other currency pairs. I've just picked up a few extra at random. So we're going to look at euro today. We'll look at gold as usual. But then I've also picked up the Turkish lira for the simple the reason I picked that up. I just went through the market list and I just chose one that I've never looked at or considered or actually had any of my fellow colleague traders speak about. And I just picked that up. The reason is to show you that it doesn't matter what market you choose to trade. It doesn't matter what currency pair you choose to trade. It doesn't matter if you choose to trade oranges or bananas or whatever it is that you want to trade. It's the very same principles that we look at. So I've just put Turkish lira on. Then we'll look at sterling, request that was put up, Aussie dollar, another major, which is pretty good to look at. Also look at the Singapore, USD Singapore dollar. So we'll have a look at that. Now, the mindset that, and we'll only do this once a month, in our trading. So what I want you to have in mind, it's a setup, what you need to be looking at as each month begins. But on a day-by-day basis, we have our daily setup. And we've kind of said this over and over and over again. And I think for guys who follow the channel, and if you go past to our historic channels, historic views, you will hear me say it over and over again. So before I look at the monthly, let me just look at the daily setup. That's something you need to do every day if you trade in of the 5-minute time frame or any lower time frame, lower than the day in any case. So what you always need to do is mark yesterday's high, and that's the green horizontal line. Then yesterday's low, see there's yesterday's low there, the red. And then I always put in the open of the day, okay? Because I want to see where the day opened and just see how the market starts to react around the open of the day if we ever come back to it. So once you have that set up, just quickly have a view of what things would look like on the 5-minute time frame. So on your 5-minute time frame, that's the time frame that we trade on this channel. You have yesterday's high, yesterday's low, and then the open. Then you start to look for your trades, your setups that you're going to trade based on the strategy that you are following. But you need to have the high and the low because the market will tend to gravitate towards that or break through it or bounce off it, whatever the case may be. Okay, so we'll come back to euro for our monthly setup. Gold, same thing that you need to have. High of yesterday, low of yesterday, and the open of the day. This is just going to be, this is a daily practice, right? This is the things that we do each day. Before we start to trade, you've got to know if you trade in intraday, that's lower than the daily time frame. you've got to have that. So I've just put those up for you for each of the time frames, each of the markets. We'll go through them. Then I'll take them off and look at the monthly review. So gold, if you then go to your 5-minute time frame, okay, you'll have yesterday's high, yesterday's low, you have the open, and things already begin to get a bit clearer, and you can start to look for your setups for the particular day. Turkish lira, very same thing. Doesn't matter what currency pair it is. I could have used my home currency, the South African rand. You could use your home currency. Could it be bananas or oranges or potatoes? It doesn't matter. Whatever chart it is, it's a very same thing. So yesterday's high, yesterday's low. Okay, open of the day. Kind of shifted a bit with my charts. Open of the day. And if you go down, if you trade the Turkish lira, you just go down into day, and yesterday's high, somewhere down here, will be yesterday's low. Okay. And the fact that you had that, you would not have been surprised with any of this price action. Okay. So, but let me not get myself tempted to start drilling down. Let's stick to the plan. Cable, sterling, pound, dollar, same thing. Yesterday's high, yesterday's low, open of the day. And then if you trade in the 5 minutes. By the way, because we trade the 5 minutes, that's why I'm making reference to it. I mean, you could be trading the hourly time frame. Okay. Trading the hourly time frame, same thing. Those key levels, yesterday's high, low, open, absolutely important to give you information in terms of how you're going to be trading. Okay. And Aussie dollar, absolutely. I love this currency pair. Long time I traded it alone. Beautiful pair to trade. Just depend on it. Time zones and what you prefer, etc. Yesterday's high, yesterday's low, open of the day. The magenta line, the purple line is open of the day. Okay, which open of the day, you can pick it up and be very accurate just from your daily time frame, or there is the open of the day within there. Just mark it there. When the market starts to gravitate to that information for you, because you might end up with just a trading range, or you may get a sudden acceleration past that, a breakout of sorts. So good information. Yesterday's high, yesterday's low, double top break above it, etc. And let's look at another currency pair which I haven't traded, but as I'm saying, it doesn't matter what you're trading. Same principles, same structure, same approach to the market. Yesterday's high, yesterday's low, open of the day. Okay, then you go down into whatever time frame that you're trading, and based on that particular time frame, you start to look for your trades. Okay. All right, just checking nothing that we got in terms of question to answer. Okay, so then you go down to your 5-minute time frame. You can quickly see, I mean, obviously, depending on when you set it up, if you were in the Asian session, you would have seen the breakout and look for opportunities. If you came in the European London session, you can see, oh, this is what's happened with below the low of yesterday. You can start to formulate some kind of a bias in your mind in terms of what the charts are showing you. So that's a daily setup. So let's start with seeing on looking at it, US dollar, Singapore dollar. So on any, so I'm talking of a monthly time frame. time frame, but it doesn't really matter. You know, whenever you open up a new chart, this is where you gotta start. Okay. It's interesting how my charts just shifts, but no problem. So very important. Any chart, any market that you trade in, you always need to just plot in the highest price ever and the lowest price ever. Okay, those are very hard levels of support and resistance, which means when the market gets there, something dramatic is going to happen. You know, it's either gonna bounce off. You know, if it's a level of support, might give you some double bottoms, etc., or it's gonna break through that quite dramatically and pull back, or it won't even break dramatically. It might just trade along, you know, create a trading range. But that's a more significant price level, highest ever, lowest ever. Okay, so I just mark it that if it ever comes into view in any particular month, it's just there in front of me, and I'm prepared. You know, in terms of how I approach it. You know, if I'm in trades, do I take some profits and hold some profits? I stop at a technical level and wait. Or do I take all of my profits? If I'm not in any trade, I'm not going to just jump in without getting full information from this particular level. So that's always important to have on any chart that you have. So we can have a look at. I've done that already on all of them. Okay, Aussie dollar, highest price, lowest price. Okay, those just stay permanently. Cable, sterling, pound, same thing, high, low. Okay. Turkish lira. That's very interesting. Okay, high, low. Gold. Kind of been working on gold for a while. High, low. Well, an interesting point, just you know, when you set these levels, every month as you go through, you must just check them out. I have absolutely no idea why my levels have shifted. But in any case, we just double check and make sure it's all right. So highest price, lowest price. And those stay permanently on your chart. Then what you're then going to do, so now we're still talking of the monthly setup. We've spoken about the daily setup. So I'm just going to remove everything that has to do with the daily setup. Okay, the high, the low, and the open. So if you're looking at a clean chart and you're not yet looking at the daily, you're not going into your daily setup to trade, this is what we're now going to be talking about. Just make sure I'm in track with guys. Hey, how you doing, John? No worries, buddy, no worries. Welcome, and hope you enjoy what we got set up here today. All right, guys, so remember we've marked highs and lows. So now you got to be asking yourself, you know, when you have a look, you know, at the chart in front of you, what are you seeing? What information is being presented to you that can start to formulate some kind of a bias, if you like, in your mind? Okay, what's existing? So if you look at this chart here, you can see already in 2021 we have that low. That's the current year. We have that high. So there's some form of a high low of the year that has been formed. The market tracked down to the low down here, and then it turned. Okay, so the bears wanted to create a new low for the year, but that hasn't happened as yet. Okay, and the bulls don't want a new low of the year. The bulls want to show particular strength for you, particular strength in the market. But now, you know, what else should you be noting? The only thing that I suggest you look at in terms of horizontal levels, okay, we'll talk about measure moves, but horizontal levels that you can see with your eyes. Find out where the market has turned most recently, and then just mark that. So what I do, remember I use the green for the daily, yesterday's high, red for yesterday's low, and the magenta for the open of the day. So I use blue. It just depends what your color preferences are. For any horizontal levels that may appear in front of me while I'm trading on the lower time frame. So nearest ones, I just use light blue. So the market turned here, the market turned here, and the market turned there. So that's my nearest concern because I'm going to be so focused on each day's trading, and I don't want to be going back every morning to do my whole monthly review and what's happened, because that's just going to take up a lot of time. So you just keep those lines there. And if you are trading and you start to see, in this case, a light blue horizontal level coming up, hey, there's something that's significant at a higher time frame. In this case, we're talking on the daily. You can go back and look at it if you want. You can just plonk up the daily and say, oh, okay, so the market turned there. So if the market turned there and we're coming back to that level, there's chances are that whoever made it turn at that point, okay, want to do the same thing. So the bulls were trying to accelerate up, and the bears created a lower high. So the bears want to defend that position. So that's a very significant level for me. So I can't just go blindly into it. I have to wait and see what is likely to happen. Similarly, if we come down here, you don't want at the end of the day to say, oh my goodness, market created a double bottom. I didn't know. If I had known, I would have made different decisions. I've just reminded myself on if I had known. The one thing which I've been remiss not to talk about quite consistently, or to emphasize on this show, if you trade in the 5-minute time frame, that's what I love trading, and this would apply to the other time frames intraday, at least up to the hourly. You've got to pay attention to the news. Okay, you have to have your news calendar. That's something that you always got to view each day. So I should probably say on a daily basis, you need to mark high of yesterday, low of yesterday, the open, and review the news calendar. You have to review the news calendar, because if you don't review your news calendar and see when the red news is coming up that affects this particular currency pair that you trade in, you are going to be surprised and not know what's happening. Price action and our strategies kind of gets parked in those 3 or 4 candles that the news is erupting when there's red news. Market just, it's driven by so many other forces around red news that you need to give it a couple of candles to settle down so things start to make sense. So if you don't do that, the reason I'm mentioning that is that while I was doing my reviews of last month, and I'm looking and saying, but what happened here? Why would I make this kind of decision when I'm trading? Then I go back and correlate with my news, and I'm like, man, this is red news. It didn't even look on your calendar that day. And based on the rules, if there is red news, I gotta be out of the market 30 minutes before. So I'm not gonna take a trade 30 minutes before any red news. And then I'm gonna wait for at least 3 candles afterwards. If I'm in a trade, I have to make a conscious decision. Do I take some profits out of the trade at that time frame if I'm in profit? And then move my stop. My stop must be at the correct technical level. We don't just move our stop at random. Or if I'm deciding if a trade that I've taken is still in a loss or is in a loss situation, I've not been stopped out, I've got to decide, take this loss now, okay? And if you don't, chances are you can get stopped out just by a move and the market can still go in your direction. So horizontal levels and news are absolutely critical. I use Forex Factory for my news alerts. I mean, you can use Forex Factory. I mean, there's many others, but as long as it gives you an alert of the red news, that's going to be, it tells you this is red news that's going to have, in other words, likely to have a significant impact on the currency pair that you are trading. So that's absolutely important every day. Set your alarm and be alert. Sometimes you have double red news. Sometimes you have triple red news. So you have CPI coming up, you have non-farm news coming up, you have another index coming up. I mean, when I see 3 red news events at a certain time, then an hour or 2, I don't want to be in that market. If I'm not getting clarity, because I know there are forces that are in the market that are just jumping in, at that particular time, that are going to move this market, but it may not be a permanent move. So best to wait, let the news go past. If it's filtered in, it's already in to affect the price. If it's not, there will be some quite dramatic price movements. And you get stopped out and you come back and say, but hang on, the market is still going in my direction. Why did I get stopped out? Well, it's red news. So keep that in mind, very significant. Keep a watch on your red news. Okay, so back here, so you just put that in there, the light blue markers or whatever, and a little bit lower, the low of the year, darker blue. So if we go past that, when the price has gone past it, I just delete them because I want as clean charts as possible. Then I know the next level, if it appears, will be that. And of course, I'm prepared and led to it. But also, when you're looking at it, so you got your visible levels of support and resistance, what you see with your eyes. What you see with your eyes, that's one. You got to plonk that, mark that in. But also, we have spoken at length in terms of price action. You need to start to see hidden levels of support and resistance. They exist. They're not visible to the eye, but they're visible to the computers. So you need to plonk those in. And with experience, you start to see, oh, well, we had a breakout here, okay, beneath that low. And the breakout went as far as that. That's a breakout beneath that to when the market started pulling back. Then the market pulled back to the moving average. So the bears that have created, the bears that created that move, that breakout move, you broke beneath that, turned here. If they're a bear, you're going to say, okay, I know there will be a pullback. We have to take profits. There has to be some fight, whatever it may be in the marketplace, but there's going to be a pullback at some point. Okay, so if there's a pullback and I'm a bear, I'm going to wait for the 10 EMA. That's solid blue, by the way, is 10 EMA. That's what we use to dictate the strength of any breakout of any move. So there's a 10 EMA. Okay, so it's going to bounce off that. So if you are a bear and you've initiated a trade anywhere here, your stop is going to be in the correct place. So if you're taking the trade here, your stop is up here. After you've seen this pullback, you can tighten your stop to the beginning of the breakout. And then you're just going to hold and say, well, I'm going to hold because unless there's a clear reversal by the bulls in here, the market is going to come down here. So there's a hidden level of support. Okay, that hidden level of support, let's just put it in so that we can see it. Okay, dotted line. So there is the hidden level of support. Why is it hidden? Because until you put the measured move, you're not going to be able to see and notice that we have a hidden level of support there. So that's one. that you always have to put your measured moves in. Then the other one that we've spoken about at length, that you should now be able to automatically, if you've been around for a couple of months or weeks with me, is the leg 1, leg 2. So what the market typically does, if there is a first leg, there is a first leg, okay, and then the pullback. So you have a first leg, you have a pullback. The market always pulls back, breathes in, profit taking, whatever you want to describe it that's comfortable with you. Leg 1, pullback, leg 2. So when you are in here and you see the setup of the EMA, you can comfortably initiate a trade, knowing that there's a high probability, 60% chance, and if there's a strong breakout, it could be higher, that the market will make an equivalent size move. First leg size, second leg down here, leg 1, pullback, leg 2. So okay, I'm gonna take my trade, put my because of the pullback, put my stop here, and I'm just gonna wait, leave it, takes as long as it wants, and wait to see if we get here, because chances are the market wanna go there. There's a low there, that's a magnet. There is a measured move that the bears are anticipating. Again, there's leg 1, leg 2. So whatever happens in here, unless there's a clear reversal pattern, we've spoken about reversals, as a bear, you're just going to hold on to your trade, and you're going to find ways. If you took the trade up here, the initial trade is all part of the same trade. If you took it up here, then, if you didn't add in here, you should have added in here. But if you didn't add in here because of your risk parameters, then you're waiting to find other opportunities to add in. So you could say, okay, now I have a double top, I have a lower high. I'm going to wait to see if I get a close beneath the moving average, and then a pullback, then I can take it. There's still profit in here. If you get a reversal, then it's a different story. So with that kind of bias, you kind of say, okay, so the market is giving me information as far as this currency pair is concerned, that there are magnets down here that can pull the market. So if I see a setup here, I can trade it. Now, the most important thing, while we're just looking at the monthly setup, okay, remember, markets are fractal. Fractal. Markets are fractal. Whatever patterns we see on this particular time frame, we can see on any time frame. Where we are on the daily time frame, this could be happening on the 5-minute time frame. So it's the same kind of reasoning and thought process that you bring to your beginning of month assessment. When you go to the 5-minute time frame, that's what you'll be looking at. Say, okay, this is what might happen. This is what's happening in the Asian session. If I get a setup here, happy to take it. Very same kind of thinking. Let's go to Sing. Okay, we'll come back to gold. USD Sing. So high, low. Okay, and we said we would just take out because we have dealt with them. Okay, so we're just taking out the daily setup stuff. So this is what you'd have. Okay, you trade in the Singapore dollar. You're saying, okay, so what do I have? I've got my extremes, high and lows. What else is there that's presenting itself before me? Well, you have this high, so you've marked that. Okay, market turned there. So if that ever appears, that the fact that the bulls tried to break above that and failed, then the bears turned the market with a micro double top and break beneath the 2-bar reversal. If the market ever gets back to that, the bears are going to try to create another double top. So if you looking to go bear to sell, you can confidently sell when that setup comes up. But also you can say, well, why would the market have turned there. Okay. You ought now to kind of say, well, let me just check if there was a reason for the market to turn there. Well, okay, so we had that high there, and with the low here, and if the market broke above that, it's likely to make a measured move. Okay, so it's kind of gone way ahead that. Let's look at this small trading range here. Okay, market broke above that. There was a decent enough breakout. I know we still have these levels of resistance there, and that's why the market went sideways. But if they manage to get above that, they might go for a measured move. And, you know, in that zone, the market kind of turned. So you had that. You've got that level. So, you know, come somewhere in there, and there's a previous level that we've marked. Okay, so we are looking at here. There's a previous level here. Okay, where you're saying, well, if the market broke above that, they want to test that. But they didn't go that far. They turned in this level. But you're not surprised, right? Because your measured moves would have indicated you, well, that's where you want to take early profits, right? But what else can we put in there? We can put in our leg 1, leg 2. So if this whole breakout move here is a leg 1, you know, and starting from there, so you say, okay, the market has done that first leg. I'm trying to find how far the market is likely to go. So there is a pullback, first leg. Okay, so it broke out above that. We got a breakout above that, got follow through. So there's a first leg, there's a pullback. I think the market may likely to get there. Earliest profits, optimal profits, and the bulls are very strong. Well, we're going to go right into the stratosphere. Point of that is you could find ways to get into trades here, stop down here and try and get there. This particular time, you're saying, okay, now the market has turned. If the bears are strong, where are they likely to go? Well, if you're a strong bear, where do you want to target? You want to target this higher low, right? So the market broke out, pulled back, resumed, pulled back, higher low. That you want to target that, because if you can get beneath that and close beneath it, you're showing the bulls that their case is weakened. If you are a bull and the bears are strong, you're going to come into the market, strong bulls, and try and defend this position and create a double bottom. Then we have some form of a trading range and try and resume the buying. So that becomes a very critical area. And you kind of know, well, if we get there and if the bears are strong enough to break beneath that, how far do they want to go? Well, they want to go and show that they can create a whole new low of 2021. So you'll be watching that with keen interest. It's not too far from the daily price action. It could be, 2-3 candles if the bears are strong. But if they get there, are they going to break through? Is the market going to bounce off that? And if it bounces off that, am I going to get a higher low and trade the other way? Because the other way, of course, you can put a measured move from here to there and see how far it goes. But Singapore dollar, if you are trading that, if you are interested in it, level of support, that's a magnet that can pull the market down. Yeah, because the bears would like to get to that level and the bulls want to defend it. And if it gets there and the bulls defend it and you get that low and that low giving you a double bottom, that's good for the bulls. If you get something like that, it's good for the bulls. Then all you gotta wait for, remember, you gotta see the setup first, then you gotta look for the entry pattern. Then just wait for a higher low, whatever is created. Then you want to take it up as high as you can, as high as the market allows you. Okay, so Singapore dollar, USD. Okay, there is a low here. That's okay, it's almost measured move low, so we can leave it to the dotted lines. Okay, but you also see that's a low of 2021. So that's a huge magnet. If the market, if we get a strong breakout by the bears beneath here and they pull back to test that, then the bears want to get there. Okay, it's going to be bearish. Then becomes the question is, where's my stop? So when the market is bearish, okay, what you worry about is where your stop goes. You don't want to be buying and selling and in and out. Unless you're a very good scalper, you don't want to be doing that. You just want to jump into your trades, see where your stop is, and manage your trade accordingly. So, John, key points to the note there of being underwater in some of your trades is stop. Where is your stop? So if your stop is in the correct place, and you've been stopped out and you followed your strategies, that's absolutely fantastic. It's absolutely okay to take losses if you followed your strategy and everything is set well. However, I think some months back we spoke about dealing with different kind of losses. If you got some losses and you haven't followed your strategy, for example, you haven't looked at the news calendar and you're in the market when you shouldn't be, then all you gotta do is kind of wrap yourself on the knuckles and just make a note to remind yourself, that you just gotta stick to strategy. The biggest thing about price action trading, is the discipline to stick to your strategy, and also the ability to reflect on all your strategies. You need to just go through and say, last month, what happened? Okay. Was I consistent with my strategy? If I was, good. If I wasn't, why wasn't I? How can I improve? How can I work on my own self so that I improve? If you don't check the news like I did last month, it's just because you've allowed yourself to get overconfident. Oh, I know I just have to open the charts and then I'm fine. I can manage it. No. The strategy says check the news so that you know where your news is. That's every day. It just becomes boring and pedantic. High of yesterday, low of yesterday, open of the day, measured moves, leg 1, leg 2, news. It just that's our business. That's what we do. You do that, you'll be fine. Then don't worry about random distribution. You'll get a string of winners. The losses will come in, but overall you'll make money. Okay, let's look at Turkish lira. Okay, so the point, guys, for and I think we'll do it just because I know a lot of guys will ask about different currency pairs. The first Wednesday of each month, we'll just do a monthly review. I'll just pick up some random currencies because I don't trade them, but just to show you that the approach and the mindset is absolutely the same, and you got to be disciplined. So if you trade in Turkish lira or you trade in an index, UK 100, US 500, Aussie 100, it doesn't matter. It's the same, absolutely same approach. Extreme high, extreme low, we've spoken about that. So now let me just check on the questions, make sure I'm correct. Hey, John, have some water or have a soft drink or have some wine on me, whatever you drink, because I also didn't check the news and it cost me. But we learn as we go along. We just make a big note and then we pick it up from there and keep moving on. But I have that glass to celebrate the learning. Okay, so Turkish lira. I don't know how many of you trade Turkish lira, but you would not know. If I hadn't told you it's a Turkish lira, you would not have known that it's a Turkish lira. But the beauty of price action trading, you start to see all of these things. It's like, man, this is getting so crystal clear. And that's where we want to go to. Okay, let me do that so you can see a bit more. Okay, so high of yesterday, low of yesterday, we've spoken about that. Basics, okay? 4 things: high of yesterday, low of yesterday, open of today, and news. 4 things you've got as chart and news. But have a look at this. So if you trade in this and you kind of say, well, okay, we are in a trading range, so that's significant, that low. I mark this just as a bit of a lesson for us. When you see a huge gap up like that, I mean, the market was way down here. I haven't gone back to check the news or the drama or whatever happened. But in terms of the chart in front of us, we have this massive gap up from this close. The market, guess what the market, from this close, market opened up here. I mean, that's humongous. And then a lot of selling, and we closed down here, and then we came back and retraced. So when you see a gap, the market is likely to test that. So from whatever side you are, so this is a gap up. The market is going to try and test that, okay, to see whatever created that. How strong are the bulls that created that gap, or whatever it is that caused that? How strong was it? It was pretty strong on that particular day because there was a lot of selling, but the selling could not close the gap. So the market remembers, the market knows that gap at some point is going to be looked at, tested, questioned, interrogated, whatever the case. So you must just mark it. So when it appears in your site, you know, you're not kind of surprised by it. You could also, on Turkish lira, mark that. Okay, pretty significant. Now, when you look at it and say, well, okay, this trading range here, if we break out beneath this trading range, if today or tomorrow we have a strong bear candle, and then another one, okay? So we have a breakout and follow through. Remember, breakout, when I see the breaking out of something, we have a breakout and we follow through. How far is the market likely to go? Those are the questions you need to be asking yourself. That's what makes this business and price action trading very interesting. So you say to yourself, well, there's a high, there is a low. Now, is that a surprise? You have another factor here. Okay, the low that was trying to close the gap, which we said is going to be tested. Now, if the market breaks beneath this trading range that's been formed here, that's the target, that's a magnet, that's what's likely to pull the market down. So this becomes an area of great significance for you. Why? Because, you know, when you do get there, there's likely to be some kind of an interesting reaction, a bounce off or a breakthrough. But until you get there, there's opportunities for you to take trades. So assuming we do get the break beneath that and follow through, so we have a confirmed breakout, then you got to be thinking, okay, there is a magnet down there. I know there's a level here. I'll have to manage my trades or take out profits, but the absolute magnet is here from the breakout beneath this trading range. So you can comfortably initiate trades, right? You can look to go short, provided you put your stop, so the breakout in the technical level, etc., and the correct level, and we've spoken about that. Now, you have confidence to sell, take some profits, hold on to your trades, try and get, I mean, this is a beautiful magnet that's going to draw the market down. I mean, if you want to keep some notes and look at it, you know, every couple of months and see, this might pull the market down on the Turkish lira, just for education, you know. But, you know, if you want to trade the Turkish lira, go ahead. In any case, it's the same kind of things. So if you see this strange kind of, you say, but what happened? You know, the market closed here. So the bulls broke out, came back, bears were strong, reversed it. So if you're a bear, after that, you've seen that close, you know, the way we trade, we say, oh, fantastic, now let's wait for the lower high to trade. But if for any reason your strategy allowed you to trade and you'd put your stop here, man, you'd wake up and say, what happened? Chances are there would have been huge slippage, you know, so you put your 1% risk cover here or 2%, whatever you trade, you might find yourself minus 4%, minus 2% double because of this. But, you know, that's why we put a stop. So it's not minus 50%. You know what I mean? But in any case, that's what you got to watch out for on the Turkish lira. Now, when you're then actually looking at your daily trade setups, I mean, you know you're in a trading range. So if you're in a trading range, what do? Trading range, once the trading range is set up, we have a double bottom here. You want to see a higher low, either higher low here, then you trade from the bottom of the trading range when I get to the top of the trading range. Okay, enter in here, stop at the right level, take your profits out here. So you either get a lower high, bounce off the moving average lower high, or if the bulls are strong, they will either today or tomorrow close above the moving average. Then after they close above the moving average, you want to look for a test of the moving average, another higher low, and look to go long. So trading ranges, beautiful opportunities to trade. If you're trading daily or you trade in 5-minute time frame, really doesn't matter. There's opportunities there. Okay. Here is the pound. Same thing, extreme high, extreme low, keep them on. Then I'm just gonna take off daily setups, 4 things, pedantic about it. High of yesterday, low of yesterday, open of the day, and news. What's the daily news announcements before us? Okay, so if you were to, let's start with a bit of a bird's eye view, then we can drill in a little bit. So what's been presented before you by this beautiful currency? Cable, sterling, pound, dollar. Okay, you can trade it if you want. And you can decide if you want to trade it together with the euro, together with gold, together with the Aussie. Then just becomes a matter of saying, okay, my total risk per the trades that I take is 1%, 2%. And if I got 5 currency pairs, I might do average today. If I got 6 currency pairs that I'm looking at, I'm going to initiate trades, but on each trade, I'm only going 0.15%. Okay, because if all 6 get taken out, 1% off, I'm perfectly fine with that. You can't say my risk is 1% per trade and not think about what your overall risk management for the day is. So if you say 1% per trade, and I'm going to put 1% on all 6, and probabilities, random distribution works against you, you're down 6%. Okay, you could be able to trade for the rest of the day and be a break even, make money. But the thing is, with when you get like 6%, all of a sudden it's not 1%, it's 2%, you panic and you start to make even more mistakes, and it ends up being just a disaster of a day. So if you got 6 currency pairs and you are comfortable with the risk of 1% or 2%, that to me means at any given time, if you were to stop trading, if the internet goes down, if you have to rush off somewhere, your overall comfortable risk is 1% or 2%. Okay, then just chunk it up, break it up between the currency pairs and trade. Okay, and see how it works out. So looking at the cable now, immediately you'd say, hang on a second, you know, you can say this. George was talking about if we have a trading range and the market breaks beneath it, it's likely to go a measured move. So we had that double bottom, you know, with this beautiful bullish price action, bullish trend, came back. We had a higher lower double bottom. Okay, now we had a double top there, and there's a low. What's likely to happen here? So at this level, if you're watching, to be saying, okay, if the bears break beneath this and give me a follow through, how far they're likely to go? Okay, the target for the bears on the cable, if they'd broken beneath that, would have been here. And all of these lows, that would have been the magnet. Okay, but guess what happened? And this is why it's so important to have clarity in your mind about what a breakout is. I've said over and over again, a breakout, you need to see a breakout beneath a level. There is a level that we had marked. Okay, did we get a breakout at that particular point? We didn't get a breakout. Okay, so at that double bottom level, the market on that day closed right at that low. And you've got to ask yourself, hang on a second, if the bears are strong, you know, it's good to talk to yourself as a price action trader and ask yourself these questions. If the bears are strong, even if it's the 5-minute time frame, why are they not closing below? Okay, because that's information. If the bears are strong, they must just close below. You know, they must just give me a proper close below this, and then a follow through. So they close right at it. We had a follow-through candle. Now that follow-through candle actually becomes a breakout candle because that's a candle that's breaking beneath that low. Then at that point, you want to have a follow-through, but you didn't get a follow-through. You got a bounce off this low here, this higher low that we had here. Okay, so we got a bounce off that. So it's a failed breakout. So then there's no surprises. Then, you know, you can leave your measured move there in case the market, you know, after this double top comes all the way down. But at that particular point, the case is starting to favor the bulls. Okay, there's a higher low, the higher low double bottom. We failed to break above it. And we then have a reversal. At that particular point, what would you be looking at? This time frame or any other time frame. So you have your setup. Now you want to see a higher low. Remember, you always need to get to see the setup. So we failed to break. Sorry about doing squeezing and unsqueezing. We failed to break beneath this. Okay, so this is a lower low double bottom. Still a double bottom with that, but it's a lower low double bottom. So after a double bottom, and there's still an extended, a larger double bottom, okay? But you want to see a higher low after this. Remember, we don't just trade off, oh, there's a double bottom, so let me go and buy. You got to see there's a double bottom tick. Now I want to see my setup. And my setup will come in the form of a higher low, just like we were discussing earlier on. It will come in the form of a higher low. Either get a higher low here, the market had gone up and come back and turned here, comfortably take, put my entry above there, stop beneath here. Or, again, like we spoke a few moments earlier, if the bulls are strong enough off the double bottom, give me a close above the moving average, you know, and a follow through close above moving average, and a pull back, then I'm prepared to take that trade. If I don't see any of that, I can't. Don't make it up in your head. You know, don't assume and say, okay, 60-40. No, there's no 60-40. There's no setup. There's no 60-40. It is not there. Then you just got to wait and get information. Now we're getting information. So off the top of a trading range, you know, the bears, you know, accelerated to create that higher double bottom at that point again. But it's within the trading range, okay? Then we had a pull back to the moving average. Okay, so bear, breakout, double bottom, pull back to the moving average, still within the bigger trading range, but that is a very significant level. So while I marked this lower high here, at that point, while you're watching all of this, you wouldn't have that. You would have that, right? That's a significant lower high in this trading range. After this bear breakout pullback, that's a significant lower high at that point. So you'll be waiting to say, well, let me see what happens. The bears created that move, pull back, and follow through. Okay, but we didn't break beneath all of that. Now let's see how strong these bears are. If the bears are strong, they're going to defend that position. And indeed they did. They gave us a 2-bar reversal in the lower high. But then the question comes, you're trying to find ways to get in, right? So here we said if you get a higher low, you can get in. Now you have a lower high, this lower high, double top. Okay, that's a lower high, double top. Okay, it's a double top with that lower high, double top, 2-bar reversal. And you're saying, okay, fantastic, the bears are strong. But then if the bears are strong, they should give me a close beneath the moving average and a pullback for me to trade. Okay, if you don't have it, don't trade it. So in this particular case, if I was trading the daily time frame, or this kind of pattern appeared before me on the 5-minute time frame, I'm going to wait to see, I might get another double top here. Still not going to trade it. I need to see a close beneath the moving average. Pullback will be a 1 candle, 1 bar pullback, whatever it may be. Then I can take a trade and look at start to take profits somewhere down here. So I hope that kind of shed some information on how you got to approach each month as you go into each month with all your charts, even the ones that you're trading. Go back and refresh what's happening at the macro time frame. Come back to the daily. What's likely to appear in your daily setups? You know, like we've got here on the euro. You know, that light blue, what's likely to appear pretty soon, what's likely to appear pretty soon. And once you have that on the monthly time frame, then go down to your 5-minute time frame and don't worry about doing the monthly time frame again. All you're going to do each day, high of yesterday, low of yesterday, open of the day, and news, because all of these are already set up for you. Then when they appear, you kind of are aware of what's happening and you can structure your trades correctly. All right. Enjoy the cake, brother. All right, guys. So thank you very much for this week's lesson. We didn't dig much into our currencies that we trade, but I think it's fair for everyone. But apply this same thinking to all the currencies, the currency pairs that you're trading. You've got to start with that macro level, then bring it down, in our case, to a 5-minute time frame, or if you're trading the 50-minute, the hourly, etc., it's the same kind of approach. Markets are fractal, which means patterns that you see repeat themselves. All right, guys, thank you very much. We will catch up next week. Thank you for logging in, and the guys in the office, I appreciate it sincerely.